Hi guys. Today lesson is about international trade policy. There are four learning objectives in this lesson and I hope that by the end of this lesson you should be able to first describe the instrument that government use to restrict trade. Second, describe the instrument that government use to promote trade. Third, articulate arguments for free trade that go beyond the conventional gains from trade. Last, evaluate national welfare arguments against free trade. Despite the advantages of open and free trade among nations, governments have long intervened in the trade of goods and services. Government intervention can be either in restricting or supporting trade. We will first look at the trade restriction policy. Trade restriction policy refers to unfavorable or unsupportive trade instrument to importers. It is imposed on foreign countries that selling goods and services to the home or domestic country. The objective of trade restriction policy is to protect the local or domestic industry, which are affected by imported goods. Hence, domestic goods will appear cheaper than imported goods. Therefore, demand on domestic goods will increase. There are two general categories of trade barriers available to governments: tariff and non-tariff barriers. A tariff is a government tax levied on a product as it enters or leaves a country. A tariff increases the price of an imported product directly and therefore reduces its appeal to buyers. A non-tariff barrier limits the availability of an imported product, which increases its price indirectly and therefore also reduces its appeal to buyers. Let's take a closer look at tariff and the various types of non-tariff barriers. We can classify a tariff into one of two categories. First, an ad valorem tariff is levied as a percentage of the stated price of an imported product. Second, a specific tariff is levied as a specific fee for each unit. It can be measured by number, weight, etc., of an imported product. Nations can use tariff to protect domestic producer. For example, an import tariff raises the cost of an imported goods and increase the appeal of domestically produced goods. In this way, domestic producers gain a protective barriers against imported goods. A restriction on the amount, it could be measured in units or weight, of a good that can enter or leave a country during a certain period of time is called a quota. After tariff, quota are the second most common type of trade barrier. Government typically administer their quota system by granting quota licenses to the companies or government of another countries. A government may impose an import quota to protect its domestic producer by placing a limit on the amount of goods allowed to enter the home country. This helps domestic producers to maintain their market shares and prices because competitive forces are restrained. In this case, domestic producers win because their market is protected. However, consumers will lose because of higher prices and limited selections of goods and services available for them. A complete ban on trade, imports and export in one or more products with a particular country is called an embargo. An embargo may be placed on one or a few goods, or it may completely ban trade in all goods. It is the most restrictive non-tariff trade barrier available. and it is typically applied to accomplish political goals. One example of a total ban on trade with another country is the US. Embargo on trade with Cuba. Although some medicine and foods from the United States are now allowed to enter Cuba, the two countries still under a very high level of embargo on trade. Local content requirements are laws stipulating that producers in domestic market must supply a specific amount of a good and service. These requirements can state that a certain portion of the end product must consist of domestically produced good, or that a certain portion of the final cost of a product must come from domestic sources. The purpose of local content requirement is to force foreign companies from other nations to use local resources in their production processes, particularly labor. Restriction on the convertibility of a currency into other currencies are called currency controls. A company that wishes to import goods generally must pay for those goods in a common internationally acceptable currency, such as the US dollar, European Union euro, or Japanese yen. Generally, it must also obtain the currency from the nation domestic banking system. Government can require companies that desire such a currency to apply for a license to obtain it. Therefore, a country's government can discourage imports by restricting who is allowed to convert the nation currency into other internationally acceptable currency. Regulatory controls or bureaucratic rules designed to impair the flow of imports into a country are called administrative delay. These non-tariff barriers includes a wide range of government action, such as requiring international air carriers to land at inconvenient airports, requiring product inspection that may damage the product itself, purposely understaffing custom officers to cause unusual times delay, and requiring special license that take a long time to obtain. The objective of all such administrative delay for a country is to discriminate against imported products. It is, in a word, protectionism. They want to protect their own domestic market and goods. So, how about a trade promotion policy? A trade promotion policy refers to a favorable and supportive trade instrument to exporters. That is, the support provided to local or domestic producer or industry in the home countries, which are selling goods and services to the foreign countries. The objective is to encourage and promote the local or domestic industry to export more to foreign countries. Financial assistance to domestic producer in the form of cash payment, low interest loan, tax breaks, product price support, or other form is called a subsidy. Regardless of the form a subsidy takes place, it is intended to assist domestic companies in fending off international competitors. This can mean becoming more competitive in the home market or increasing competitiveness in international markets through export. Next, foreign free zones, which refer to the designated geographic region through which merchandise is allowed to pass with lower custom duties or taxes, or with fewer custom procedures. There are four major types of free zones, that is, free ports, free trade zone, export processing zone, and special economic zones. These free zones allowed components to be imported at a discount price from the normal duty levied. Learning the government regulation of other countries can be a daunting task. A company must know whether its product is subject to a tariff or quota, for example. Governments of most nations, therefore, have special agencies responsible for promoting export. Such agency can be particularly helpful to small and medium-sized businesses which have limited financial resources. Government trade promotion agencies often organize trips for trade officials and business people to visit other countries in order to meet potential business partners and generate contacts for new businesses. For example, Minister of International Trade and Industry is responsible in assisting domestic producer of Malaysia in international trade activity. Thus far, we have discussed that trade policy can be either restricting or promoting. The idea of free trade is not uniformly agreed or accepted in all nations or countries. Some support while some against. Before we discuss the argument for both cases, that is, support and also against free trade, let's have a look on what is meant by free trade. Simply said, free trade is free from government intervention and interference either on import or export. Hence, no barriers or restrictions for goods and services to be traded between countries. There is no restriction in terms of tariff or non-tariff to importers and no subsidies provided to exporters. Both support and against cases of free trade is based on the cost-benefit analysis. Let's now see the arguments that in support or favor of free trade. Few countries have anything approaching completely free trade. The city of Hong Kong, which is legally part of China but maintains a separate economic policy, may be the only modern economy with no tariff or import quotas. Producer and consumer are freely to allocate resources in an efficient manner when government do not distort market prices through trade policy. Recall in the previous lesson which we see that tariff mainly benefit large countries like the US but not on small countries. We can see from this figure for the case of a small country which cannot influence foreign export prices. A tariff causes a net loss to the economy, measured by the area of the two triangles in blue. It does so by distorting, changing the economic incentive of both producer and consumer. Conversely, a move to free trade eliminates this distortion and increases national welfare. Hence, national welfare of small countries is highest with free trade. With restricted trade, consumers have to pay higher prices and consume too little, while firms produce too much. Therefore, it will cause distortion both in demand and supply. Here is an example to show the cost and benefit analysis when we remove tariff on imported goods. First of all, the removal of tariffs will lead to lower prices for consumer. Prices fall from P1 to P2. This fall in prices enable an increase in consumer surplus of area 1 plus 2 plus 3 plus 4, the demand curve. Imports will increase. The government will lose tax revenue of area 3. Tax revenue was from import. Domestic firm producing this good will sell less and lose producer surplus equal to area 1. However, overall there will be an increase in economic welfare of 2 plus 4. That is, the original 1 plus 2 plus 3 plus 4 now will be minus with 1 plus 3. Hence, we get the beneficial economic welfare 2 plus 4. Therefore, the benefits of removing tariff is bigger than the cost in terms of producer surplus. In the case of small countries in general and developing countries in particular, many economists would argue that there are additional important gains from free trade. One kind of additional gains involve economy of scale. Protected markets limit gains from external economies of scale by inhibiting the concentration of industry. When the economy of scale are internal, they not only fragment production internationally, but by reducing competition and raising profit, they also lead too many firms to enter the protected industry. With a proliferation of firms in narrow domestic market, the scale of production of each firm become inefficient. A good example of how protection leads to inefficient scale is the case of the Argentine automobile industry, which emerged because of import restriction. An efficient scale assembly plant should make from 80,000 to 200,000 automobiles per year. Yet in 1964, the Argentine industry, which produced only 166,000 cars, had no fewer than 13 firms. They were supposed to be able to produce more than this figure. Another argument for free trade that by providing entrepreneurs with an incentive to seek new ways to export or compete with imports, free trades offer more opportunity for learning and innovation than they are provided by a system of managed trade, where the government largely dictates the pattern of import and export. So, what will be the argument for those that are against free trade? Most tariff, import quotas, and other trade policy measures are undertaken primarily to protect the income of particular interest group. For a large country that is able to affect the prices of foreign exporters, a tariff lowers the price of imports and thus generate a terms of trade benefit. These benefits must be set against the cost of the tariff, which arise because the tariff distort production and consumption incentive. It is possible, however, that in some cases, the term of trade benefits of a trade outweigh its cost. So there is a terms of trade argument for a tariff. At a small tariff rate, a large country welfare is higher than with free trade as shown in this figure. As the tariff rate is increased, however, the costs eventually begin to grow more rapidly than the benefits, and the curve relating national welfare to the tariff rate turns down. A tariff rate that completely prohibits trades from TP and beyond leave the country worse off than with free trade. Further increases in the tariff rate beyond TP have no effect, so the curve flattens out. At point 1 on the curve, corresponding to the tariff rate TO, national welfare is maximized. The tariff rate TO that maximizes national welfare is the optimum tariff. By convention, the phrase optimum tariff is usually used to refer to the tariff justified by a terms of trade argument rather than to the best tariff given all possible consideration. The optimum tariff rate is always positive, but less than the prohibitive rate TP that would eliminate all imports. Another argument against free trade is that it causes domestic market failures. This includes the possibility that the labor used in a sector would otherwise be unemployed or underemployed because producers will shift to sectors that have higher demand and leaving other sectors as it is because wages do not adjust. The existence of defects in the capital or labor markets that prevent resources from being transferred as rapidly as they should be to the sectors that yield high returns, and the possibility of technological spillover from industry that are new or particularly innovative. Moreover, property rights not well defined or well enforced, since no protection or intervention from the government under free trade. The domestic market failure arguments against free trade is a particular case of a more general concept known in economics as the theory of the second best. This theory states that a hands-off policy is desirable in any one market only if all other markets are working properly. If they are not, a government intervention that appears to distort incentive in one market may actually increase welfare by offsetting the consequences of market failures elsewhere. For example, if the labor market is malfunctioning and fails to deliver full employment, a policy of subsidizing labor-intensive industry, which will be undesirable in a full employment economy, might turn out to be a good idea. It would be better to fix the labor market by, for example, making wages more flexible. But if for some reason this cannot be done, intervening in other markets may be a second best way of elevating the problem. When economists apply the theory of the second best to trade policy, they argue that imperfections in the internal functioning of an economy may justify interfering in its external economic relation. This argument accepts that international trade is not the source of the problem, but suggests nonetheless that trade policy can provide at least a partial solution. So, we can see that the cases for and against free trade is like a coin with two sides and it is never ending arguments. The father of economics, Adam Smith, generally supported free trade, arguing that countries should specialize in the area of expertise. Smith saw trade as a way for all countries to become better off. Smith's student, Ricardo, made case for free trade on the basis of comparative advantage. Ricardo shows that removal of tariff will lead to a net welfare gain, the gain of consumer outweighing the loss of producer. Whereas Friedrich List make a case for tariff and protectionism. List argued that moderate tariff could be justified at certain times in economic development. So, that's all for today and I see you in next lesson. Thank you and bye bye.